Hi, everyone. Welcome to this live Ask Me Anything with Mike Green, Chief Strategist and Portfolio Manager at Simplify, but he doesn't need any introduction for most of you. Hi, Mike. How are you?
I'm doing well, Maggie, and yourself?
I'm doing well too. Considering the circumstances, I think everybody's feeling a little anxious, and a lot of people have a lot of questions. So we couldn't have planned this any better. And it was interestingly planned ahead of time because we were going to talk about the state of the pension system for our Plus members as part of our special 2 week series that we're doing. But given what's going on with the regional banks here in the US and the questions that so many of us have, we decided to open it up more broadly. We really want to make sure everyone's getting as much sort of accurate information and just insight from the best thinkers as possible, because that's our mission. So welcome everyone. I know there's a lot of questions in the chat already. Go ahead and drop yours in there as well, and we'll get through as many as we can. So Mike, first off, let's start what's happening. I think it's all tied together, by the way, but let's start what's happening just over the weekend. And what's your assessment of the situation unfolding in the US banking system right now?
Well, I think what we're seeing in the US banking system is a glaring issue or omission in terms of our risk controls, which have always been focused around the idea of spreads as compared to the absolute level of rates. We've never really had to think about this before. So when you look at things like financial conditions indices, they inevitably are composed of tools that would have been useful in navigating the global financial crisis. What is the spread between high yield bonds and treasuries? What is the spread between investment grade and treasuries, et cetera? None of the metrics include things like what is the absolute level of rates today versus what the level of rates were last time somebody refinanced. And in fact, the navigation system is in many ways completely messed up, because if you see a significant increase in interest rates, which in turn leads to a much higher level of financing costs, most corporations are going to try to delay refinancing and locking in those much higher rates. We've all experienced this in our mortgages, et cetera, people choosing not to refinance, not to move because they have a favorable rate. That's exactly what happened with Silicon Valley Bank, effectively, right? They looked at loans or assets that they had purchased in an environment of low interest rates and high cash inflows, and basically said, you know what, we're just going to mark this in what's called the hold to maturity book. We're going to keep it separate so that we don't have to flow through those losses on our balance sheet. We think the credits themselves are high quality. And they became exposed to the level of interest rates as compared to a deterioration in spreads. That's really the most interesting thing about what's happening in the financial system right now, is that we're discovering that there are costs and risks associated with the extreme behaviors that Jerome Powell has evidenced by hiking rates in a totally unprecedented manner.
So I think this really strikes at the heart of what a lot of people are wondering, including Justin, and I'm sure a lot of the questions are going to be around this. And very simply, you know, is this part of a larger issue? Is this situation isolated to just a few regional US banks, or are many, many more firms, institutions going to be finding out that they are also at risk when you're talking about level of rates?
Well, unfortunately, I think that's going to be the case, right? What we're going to discover is that many high yield corporations which have failed to refinance, right? They've looked at a maturity wall out in 2024, and they've said, we're going to delay refinancing as long as we possibly can. Now you're watching both the economy slow and the operating metrics begin to deteriorate at the same time that they're facing the need to refinance going into 2023, 2024. You don't want to wait until the last minute to refinance. That obviously creates some real risks. And suddenly they're forced to confront the reality that financing may make them an uneconomic entity, right? That has been delayed. And again, ironically, the systems that we have in place for measuring risk would suggest that low level of issuance that we saw in 2022, where it was down 50% year over year versus 2021. But this issue, the irony is that the systems that we have in place would suggest that failure to issue debt, right, which actually is would be a prudent decision to finance, bite the bullet, deal with the costs associated with it, et cetera. That shows up as a decline in speculative activity. That's saying that there's less risky activity underway, even though any reasonable person would consider delaying a refinancing choice to be a more risky activity. And so again, like when we have tools that are built for the global financial crisis, there's a very real chance that we actually run the exact opposite experience this time around. And as we've seen over and over and over again, regulators can only manage what they're measuring, right? And they're not measuring the level of rates themselves as a significant risk issue, at least in the headline indices.
Yeah, so two things there. I think that's really important because there's been a lot of talk about this being just reckless mismanagement on the part of bank executives. And it sounds like, and I don't know these bank executives. I'm not looking to drill down into that, but it sounds like what you're saying is this is a systemic issue in terms of how everyone was operating post GFC, which means that then it wouldn't, in that case, be isolated to these specific banks.
Yeah, I wish I had it up in front of me, but I'm sure you've seen, and most of your audience has now seen the chart that goes around that I believe was put out actually by an FDIC commissioner, highlighting the dynamics of unrealized losses on banks' balance sheets, right? That this trumps the experience of what we saw in 2008, where the accumulated level of unrealized losses on high quality assets, agency MBS, high quality MBS, treasury bonds, et cetera, that have been purchased are approaching like literally unrecognizable levels versus anything we've seen historically, right? That is sitting there as a risk on the system. Now, will that risk be realized? That's introducing a second issue, which I would argue that regulators have not at least made explicitly clear in their analysis. And this is what really brought down Silicon Valley Bank, is as interest rates stay high and banks are trapped in assets that offer low yields, their ability to pass through higher interest rates to their depositors as higher income is impinged, right? If I'm trying to manage my profitability against my assets that yield 2%, in the case of Silicon Valley, we're talking 1.7%. If I'm limited in my ability to pass that through, that then makes my deposit base vulnerable. And that tends to be an exponentially growing factor. It's a component of, one, the differentials widen over time. We're now seeing a spread between the costs that are being, the yields that are being paid on deposit bases versus money market funds is approaching a historically extreme level, somewhere in the 350 basis point range. That's enough that it's encouraging people with increasing frequency to begin switching their balances out, right? That's what did in Silicon Valley Bank, was the unique characteristic of its deposit base that was very, very closely tied in terms of a communication network. So once people started saying, okay, we can get, hey, is your portfolio company that's banking at Silicon Valley Bank, have they considered that if they put that into treasuries or a money market fund, that they could get 3 or 4% as compared to the 0.5% or 1% that they might be making at Silicon Valley Bank? That can be a really big deal when you're talking about large corporate balances. And actually, one of my friends that used to work with me at Teal Macro has started a treasury operations business for outsourced treasury management that could be used by these types of companies. They're looking to generate additional yields on that. We're starting to see an increased focus on that sort of stuff. Once that kicks in, it causes what's called the beta on deposits, right? The rate at which deposits respond by flowing out of banks given increases in interest rates. That beta is not a stable beta. It doesn't stay at 0.5 or whatever. It climbs over time as more and more people say, hey, were you aware of this, right? My big fear is that we held up a giant sign to the American public this weekend and said, oh, guess what? You can make a lot more money in money market funds than you can in your banking deposits, right? I can tell you for a fact that a number of people have called me and said, is that true? Right? Could I really make 4 or 5% by just going into a money market fund? I'm like, yeah. Were you not paying any attention? No, I wasn't paying any attention because people don't, right? They don't really, that's not their focus. They want to, play with their kids and cook dinner and do all sorts of fun stuff.
So what are the implications of that?
Well, so there's a couple of things that are going on, and let me share a chart with you guys. Hopefully I can pull this up properly. Give me 1 second here. Here we go. If you can pull up the chart that I have on my screen right now. This is looking at the change in bank deposits from peak, right? Now, a lot of people will show the chart that shows bank deposits exploded in 2020 and say, we're just normalizing. The problem is, again, remember what happens with banks. Banks are all about maturity transformation. They take short-term deposits and they invest them in long-term assets. That's, again, what happened with Silicon Valley Bank. They took in the deposits, they lent them out, and now as people are demanding those deposits back, they have a maturity mismatch, right? So what you actually care about in terms of risk in a banking system is this drawdown dynamic. And we only have data back to 1971, but we're already at levels that are suggesting that, this is unlike almost anything that we've seen in the past 50 years. The drawdown in bank deposits is draining cash from the banking system and creating risks. Silicon Valley is the extreme version of that, but that's where you would expect to see the first warning signs, right? This is not a homogeneous process. It's not like JP Morgan is losing assets rapidly or Bank of America is losing assets rapidly. This is a process that is particularly risky for those regional banks, et cetera, that could be exposed to very tight-knit communities that all simultaneously say, oh, by the way, did you realize that you could get a lot more money out of this?
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
So do you think that, and we're going to get to the questions that are coming in now, do you think that the banks need to do something about the deposit rates? Do they need to immediately raise the interest rates on deposits so that they can compete with money markets?
Well, the problem with that is then you destroy the bank profitability, right? Because the spread, the net interest margin, collapses under that framework. Now, will they do that for solvency purposes? Of course, and that's what the BTFP, the new program that was introduced by the Fed over the weekend, that's what that attempts to do, is to address that solvency issue by saying, look, if you're facing this type of risk, we will lend you money at 5% against those assets that you bought that you only yield 1.5%, right? But we can all do the math that if they're willing to lend to us at 5 against assets that yield 1.5, that's a negative net interest margin and damages and destroys the profitability of the bank. So they're going to try to avoid that as long as they possibly can.
So Gary asking, how is this being viewed internationally? Are funds being moved out of the country?
Actually, I would suggest it's the exact opposite. So what we're actually seeing is money coming into the United States to take advantage of the much higher interest rates that we have, particularly in treasuries. And one of the key risks that I would highlight is that the gorging on low interest rate loans and low interest rate treasuries, a huge fraction of that actually occurred abroad, right? Whether it was Taiwanese insurers or it was Australians or it was investors from Europe who saw the differential yields that could be recognized in the United States, where at least yields were positive. They've accumulated these assets and now suddenly they're faced with fairly significant losses. We don't have the same transparency in terms of their cash flow characteristics that we might have for Silicon Valley Bank, for example. So that's a risk that's sitting out there. I'm not seeing any evidence that we're seeing cash drained out of the United States.
Robert asking, thanks for everything. How does it stand for Credit Suisse as far as you know? Bust incoming as default swap prices indicate, CDS at all-time high, but anything concrete they may actually, he says, go bust, let's say come into some sort of real trouble?
Well, I think the expectation, so first of all, I just want to be very clear, like I'm not an expert on Credit Suisse. I don't know their loan portfolio. I don't have full transparency in that. But like many institutions at the very large scale financial, institution component, particularly out of Europe, they were relatively aggressive participants in derivatives markets and funding markets like hedge fund prime brokerage activity. They were very badly damaged in the Bill Hwang dynamics. They're facing a fairly serious issue in terms of their control systems that suggest that they don't really know what's going on either, right? So for me to presume that I can tell you what's happening within a bank that has already articulated that they themselves don't quite know what's going on would be presumptuous. Not that I have any problem with being presumptuous, but the the key issue that I would just highlight there is when you don't know, banking deposits, banking relationships, as we see with Silicon Valley Bank, like there's a little bit of a feel-good component associated with it, with being able to say, I have a 30-year banking relationship, but man, that takes a deep second place to give me my money back.
Right. And I think the fact that people are asking these questions, and we're going to get to a couple more that are about, it's we all went through the financial crisis when it seemed like it was limited and then it wasn't. It seems like a lot of people are worried. It's as much psychological and confidence at this point about where the next shoe is to drop. That's a problem when you start to worry about counterparty risk and whether you have access to your funds.
Yeah, so I describe it as when near cash or presumed cash becomes non-cash, that's where panic occurs, right? Because people don't really plan for that. That's what Lehman Brothers and AIG were actually all about. Lehman Brothers, when Lehman Brothers failed, many market participants who had presumed that their money was cash, that they were holding cash in their portfolios, suddenly saw those portfolios with no cash, and that led them to be forced to sell stuff, right? When we talk about the banking dynamics, it's wonderful to think, and I know a lot of people that watch Real Vision tend to disparage the Keynesian framework. There's a lot of truth to the Keynesian framework, but one of the critical issues with it is this idea, and this is broadly true for economics in total, is this idea that you're using aggregates, right? So when I show you change in bank deposits from peak, and they're down 2.5%, you might say, well, that's not a big deal, until you recognize, wait a second, that incorporates Silicon Valley Bank, which is actually down 25%, right? And then Silicon Valley Bank, it got worse because it fell another 25% over the course of basically a single day, right? So when you start to think about those dynamics, you recognize how these issues become pretty significant. And again, the traditional models, things like financial conditions indices, are telling us there's no problems, right? Everything is totally fine. Well, I'm sorry, but we've now frozen withdrawals out of private real estate funds. We've now had 3 bank failures over the course of a weekend, right? We're seeing, high yield issuance and investment grade issuance has cratered for the most part. There was some easing of it earlier this year. And all of this is happening with very low unemployment levels, with the perception that things are super stimulative, et cetera. I'm sorry, that's just not how it works, right? I mean, housing markets don't collapse. Transaction activity doesn't collapse in the face of a super strong economy. It's telling you that something's off in the way we're measuring stuff.
Absolutely. And I have to mention that we sat down just a couple of weeks ago to record an episode for My Life in Four Trades, our podcast. And at the time, you said something to me that really stuck with me after we talked, and I was thinking about it. And it was something to the effect that the kindling's on the fire, right? Like there was just, you had a sense that, and the question was, who's going to throw the match? And part of it was, I have to believe the Federal Reserve's actions that we're going through now, the unprecedented hiking cycle, the intensity with which they're pursuing inflation, that's going to create conditions under which somebody gets stressed enough that they go postal. And I want to be positioned for that opportunity. We'll talk about that a little bit later. But those were chilling words, and it stayed with me. And that was only, I think it was 2 weeks ago, Mike, that you said that. So the question now, I think, is how does this, what are the waves now that ripple out? So Johnny asking, are countries outside the US starting to question the dollar?
Again, if anything, I understand the focus on the dollar and the fear about the dollar. And when you talk about people questioning the dollar, it by and large involves them saying, I can't get enough of them. Is there something else we could use? Right? We've seen these types of waves of scarcity in terms of financing capability, et cetera, that have happened from time immemorial, right? Whether it's a coinage shortage in colonial America to the dynamics of, the Middle Ages in Europe, when effectively there was no coinage and people used various forms of tally sticks, et cetera, wood that was easily available to manage credit relationships, right, as compared to coinage. So what we're experiencing right now is an environment in which there's two really important factors that are playing through. One is that the U.S. no longer needs to buy nearly as much oil or energy as it has historically. The U.S. has moved from an importer of that, which means that we're sending dollars abroad, to an exporter of it. That reduces or significantly changes the cash flow patterns that are traveling around the world. The second component is that you have the dynamics of a country like China that is beginning to experience significant stress on its internal economy, its ability to create domestic demand. And so even though it's the world's largest exporter, it desperately is trying to figure out how do we sell more of our aggregate supply abroad as compared to domestically, right? When those things tend to play together, when things become really concentrated in that manner, you can imagine a lot of these secondary countries as effectively being caught in rapids, right? The currents between the changing trade patterns around the world are causing breakdowns all over the place. And whether that's Venezuela or Argentina or Brazil or any number of places around the world, there's just a tremendous amount of uncertainty and changing patterns. And that can create both opportunity and it can also create chaos. Typically, when you combine fixed rate obligations, i.e. debt, with changing patterns of income, it creates a problem, right? Again, it doesn't matter the aggregate quantity of debt that's owed. If I owe money and I lose my job, even as my neighbor doubles his income, and if he doesn't owe any money, right, the net dynamic is credit deterioration.
William asking, where are U.S. interest rates going now, given any further increases can only exacerbate the banking crisis?
Well, again, I think unfortunately the information systems that we have and the tools that we have for managing these types of risks suggest that that's just not a risk, right? So this would feel a little bit like like this was a rogue wave, right? This came out of nowhere. We're trying to do a great job of building a narrative that says this was irresponsible management by Silicon Valley Bank. That's just not what actually played out here, right? Was it uniquely exposed? Did management make mistakes? Absolutely. But this was not, what people thought was going to happen for the most part until, very early this year when it became apparent that they had the liquidity issue, not a credit quality issue. Now, what we haven't even begun to see yet is the dynamics that I'm referring to, where the much higher refinancing costs, does that in turn create its own credit issues? My guess is yes.
And
right?
that's exactly Kevin's question. Kevin's asking, how much concern should there be on the wave of debt that must be refinanced at higher rates, further deteriorating bank balance sheets?
Absolutely the right question. And again, like if you remember going into the global financial crisis, the chart that made its rounds on a continuous basis, primarily coming from Ivy Zelman at Credit Suisse, now with her own firm, if you looked at the chart that would go around, it talked about the refinancing wave, right? And the resetting of adjustable rate mortgages to higher levels of interest rate, and how that refinancing wave is going to draw cash out of the economy and create risks. The irony is that never happened. Right? Those flexible interest rates actually ended up saving many people because they were able to lower their interest expense, lower the cost of servicing their home as the economy deteriorated and the Fed cut rates to unprecedentedly low levels, right? The challenge this time around is very little activity in terms of debt issuance has occurred at these much higher levels of interest rates. The vast majority of things like mortgages, et cetera, are set at much, much lower levels of interest rates. And so the Fed would have to cut rates by an extraordinary degree to provide the degree of stimulus that came in the last cycle, right? So like we're in a very interesting pickle, right? People are convinced that the Fed has to keep hiking rates to fight inflation. It's almost certain, given the reversal that we've seen today in the CPI print that came through, that the Fed is going to feel that they need to hike rates yet again in this next meeting. What causes that to stop? What causes them to get to the point that they can respond by cutting interest rates to a level that begins to alleviate some of these issues? That's unknowable at this point, but it certainly feels like it's out there somewhere. Jaws beneath the surface. We can hear the sounds. We just don't know where he's going to strike.
We have a question. So you mentioned before, that shortage of dollars, people look for alternatives. Chris saying, hi all, I'm not a Bitcoin maxi by any stretch, more bullish Ethereum, but how is this not a shining moment for Bitcoin? You might have been talking more in the chat than directing it to you, Mike, but I think it's an important question because, we do have people sort of saying, what about gold? What about Bitcoin? How do I, all in a desire to find something that's maybe going to hold up or not be correlated with this big sucking sound we hear around the repercussions for Fed policy. I know I don't believe you're a fan of crypto, but thoughts on that for people maybe considering that?
Well, so you're correct. I'm not a fan of Bitcoin or many forms of crypto as they exist today. What I've highlighted for people and said repeatedly is that it is tapping into something that is actually necessary, which is truly natively digital securities and the ability to move away from the analog nature of much of the transactions, right? So I always point out for people, I keep it on my desk actually for these purposes, this is a check that I received from Southwest Airlines because my mother bought my daughter a Southwest Airlines actual stock certificate that was then framed on her wall, making me the shareholder of record. So I receive 14-cent checks on a regular basis, right? Like this is just stupid, right? It is stupid. And so smart contracts and truly natively digital securities will ultimately address that. Unfortunately, I think the Bitcoin and the dynamics that we have today in terms of crypto are largely a distraction along that process.
So certainly not ready for prime time yet in terms of the crisis that we're seeing.
Yeah, I mean, it's a speculative security, and in some ways, you could argue that it is building the rails and infrastructure that will ultimately facilitate that transition. Unfortunately, the reason why I'm not a fan for Bitcoin, and that is one, I think Bitcoin's already dead on arrival. It's shown that there's no real use case other than basically hiding money or illegal money transferring or various other components of that. And by the way, I fully understand that if you're in Venezuela, you're going to have a different experience, but we don't build the world around the experience of refugees and political refugees in Venezuela. But those types of dynamics. Unfortunately, with Bitcoin in particular, because it's an ASIC-based mining process, we're spending a lot of money in building stuff that is actually going to be totally useless going forward. Again, that's my opinion. You can use it for whatever you want. But what you're seeing right now is a situation in which, yes, everyone is saying, "Gosh, this is Bitcoin's time to shine." So people are buying Bitcoin. In an environment in which a huge chunk of the Bitcoin is basically tied up in various bankruptcy courts around the world, right? So, it's actually quite interesting that there is a inability to sell many of these large pools that have been caught up into the bankruptcy courts at this point as we effectively litigate who gets the proceeds, et cetera, when they're liquidated. We don't know that yet, so we just haven't sold them, right? Those sales are still out there, and the off ramps to get out and back into fiat have been damaged. That makes a perfect situation for price appreciation, right? You can't really sell large pools of capital are tied up in the space and effectively frozen. And into that, people say, oh, this is Bitcoin's time to shine. So they go out and buy it. And guess what? It's a self-fulfilling prophecy. The price goes up. And I use Bitcoin for more transactions. Am I seeing more on-ramps emerge? Am I seeing more off-ramps emerge that allow it to be better integrated into the global financial system? No, I'm seeing the opposite, actually.
Gary asking, bank unrealized security losses are only on one side. What about the gains on the interest rate swaps?
So that's actually not correct. And this is part of the point. So I wrote a Substack this weekend talking about Silicon Valley Bank. Most people would know, who are bothering to listen to this, would know that you can go to my profile on Twitter at ProfPlum99. There's a link to my Substack there. You can read the piece that I wrote called Valley of Despair. Once you elect to move to a hold to maturity designation, which is what those unrealized losses are, for you to put a hedge on would mean that you are now exposing your income statement to the unmatched behavior of that hedge. You effectively become a giant short on interest rates in terms of the performance of your income statement. That would be very unexpected and unusual for a bank to do. And so yes, there are some banks that are holding their securities in available for sale that have hedged their interest rate exposure, and they have offsetting components, but that unrealized loss dynamic is actually a true number. There is no offsetting hedge to that.
Rex is asking, where do you see the price of gold in the next year? Is this where everyone is going to go if they're nervous, Mike? Or should they? How should they be thinking about that?
I mean, if anything, I would suggest that part of what we continue to see is a debate with the younger generation. Do I buy Bitcoin or do I buy gold? There's much better support for the younger generation in things like Bitcoin. I own gold in my portfolios because it has a interesting dynamic in that it is largely orthogonal, and it does have the characteristic that when people get scared, they do kind of return to their historical framework. But unfortunately, I'm not really a believer in the narratives around, gold has to appreciate or allow you to buy a fine men's suit, et cetera, right? The traditional argument that the price of gold is, equal to a fine men's suit, like, man, I just bought a fine men's suit for around $900, right? So that would imply that the price of gold is roughly 50% or 100% too high. That's kind of where I think we are. I think people are very focused on both Bitcoin and gold as alternative measures of financial systems that allow them to escape, but they don't offer any embedded return associated with it other than if other people step in and buy it, right? That may change in the future. There are ways to generate yield associated with these things. But in an environment of 4.5% to 5% treasuries, I just don't find either one particularly compelling.
So it's interesting as we're talking, the US session is open. Dow's up 450 points, S&P's up 2%, VIX is down 15%. What do you make of that when we're just talking about the fact that this is not likely limited to these two regional banks?
Well, look, I think that there's a couple of things around this. I think this. I also write a note for Tier 1 Alpha that we send out on a daily basis. And one of the things that we highlighted last night or this morning in our note was that the implied volatility for the day, right? So the bets that people were placing around the move in the S&P 500 for this one day, the implied volatility was somewhere in the neighborhood of 50%, right? Which would suggest that the options price was expecting somewhere in the neighborhood of a 3.5% to 4% move. When people place those sorts of bets, dealers have to hedge their exposure in a variety of ways. And when that volatility fails to materialize, that tends to be a very positive impulse to the market, right? Effectively, people are saying, I think there are incredible risks today. I'm really terrified and scared, right? And I'm going to optionalize a lot of my exposure. When that fails to materialize, when the CPI report comes in line, et cetera, that collapse in implied volatility naturally creates upward pressure on risk assets. So I just don't think that there's any information in today's session. I think this is largely an option-driven phenomenon right now.
I think that's really good to know. You got to bear with the noise for a moment. But Mike, you've been through so many crises. Is there any parallel to the S&L, crisis that we saw unfold?
I think that's exactly the right model, right? That was exactly the same framework in which suddenly savings and loans vehicles that were banned from competing for deposits by offering higher rates through what was called Regulation Q were suddenly faced with non-competitive deposits that required them to go out and seek riskier investments, right? That process of going out and seeking riskier investments so that you can pay higher returns to depositors, as you go through that process, as you're initially providing credit, well, nobody defaults initially, right? That was a unique feature of the global financial crisis, was what were called first period defaults, where basically people had just flat out lied on their loan applications. In the case of the S&L crisis, it took longer for it to play out, but the process of providing that credit to the system raised asset values. It created lower financial risk because I could refinance, even if it cost me more and more money, to refinance. I was able to do so because people were desperate to lend money to me. As that withdraws, it creates its own risks, right? They come right back into the system and reemerge, and it shows up as a crisis. And so, yes, I think that's exactly what we're going through, where the banking system is seeing its assets drained out. You can actually see on the chart that I had put up in terms of the change in deposits, how much further we actually are than the S&L crisis in terms of its dynamics. Right now, this does not, I want to be really clear about something. This is looking at banking institutions, not the S&Ls themselves. If I were to look at the S&Ls themselves, it would look more like a 25% decline in deposits, much more like what you saw with Silicon Valley Bank. So I don't think we're there yet. But again, this is an exponential curve. As more and more people say, why in the world would I keep my money with the bank? As higher and higher yields are being offered to me in money market funds, et cetera, this snowballs and accelerates, and effectively you're forced into those types of conditions.
And the only way out of that, so if that is the case, the banks cannot compete and raise the rates because it'll kill their profitability. So the only option is for the Fed to bring down rates, so
that's the catch-22, right? So, Jerome Powell, by hiking as aggressively as he did, by being late to the process of hiking in inflation or withdrawing stimulus under inflationary conditions, and then responding with an unprecedented level of violence on interest rates, has created this situation, right? Now, the irony, of course, is that people are very focused around the dynamics of inflation continuing, even as we see evidence that that's increasingly being driven by other stuff. So I'm going to flip over and show people a chart. Let's see if I can do this here properly. So this is looking at flexible CPI versus sticky CPI. The components of flexible CPI would include things like food, gasoline, prices that change on a very regular basis. What are your utility costs, et cetera, that are tied to things largely like commodities. Now, importantly, that's a much better descriptor of our historical CPI, right, than what we experience today, which is largely dominated by very slow moving components like owner's equivalent rent, right? So today's CPI coming in at 6% and the core CPI coming in at roughly the same level, remember that a giant chunk of that is tied up in this badly lagging index called owner's equivalent rent that effectively lags by about 15 months. That's what you're seeing in the sticky CPI, which is, continuing to rise, but is way below the levels of what we saw in the 1970s, when that component of the index was directly tied to mortgage rates, et cetera. The flexible CPI has collapsed. Right. I mean, that was what people were experiencing when they're saying there's no way that the inflation numbers are right. My costs are going up much more than that. Absolutely correct. The flexible components of CPI moved up to close to 20% on a year-over-year basis. That number is now down below 5. Right. So it's been a collapse like many others we've seen in history. My general perspective is that most of what we're seeing in inflation at this point is badly lagging in character. But the Fed is committed to a path now that says, as long as this number remains high, as long as this increasingly dominated by sticky components inflation number is high, we're going to keep hiking rates. And they feel that their credibility is at risk, which, I described this early on in the process of, it's not all that different from parenting a child. Once you've kind of fully committed to, I don't care what your reason is, I've told you to do this, you're going to do it, right? If you back away from that, you've destroyed your credibility, even as you destroy your credibility by behaving in an increasingly irrational manner to say, no, this is what I told you to do.
Yeah, of course, it's also being fed by a very large group of people who believe we are in a structurally higher inflation environment. Whether they look at energy, the supply side, they look at wages. I mean, we have them on air all the time saying that.
Yeah, and look, there may be some evidence for that, right? We can certainly argue that China, our decoupling from China can create conditions of higher inflation. I would point out to people, though, that China is no longer the low-cost operation around the world. And ironically, the decoupling from China is accelerating the process of relocating production facilities to the new low-cost regions around the world using higher quality and more innovative production techniques, right? So everything we learned in China is now being transferred abroad. So I just don't buy it. I'm going to see if I can pull up one more chart here. Let me see if I can pull this up here. So look, this is part of the challenge that I have with that general view, which is we had a very unique period that most of us think of as normal, right? The dynamics of the 20th century in which global population growth exploded in a way that created constant scarcity is something that is not being repeated on a look forward basis, right? And so the components of the 20th century in which the number of people in the world that were looking for resources exploded roughly 600%. If I look out over the next 100 years, that number could very well contract, right? Certainly in commodity intensive regions around the world. So I just don't buy it. I'm sorry. I think that there is, I fully understand why they say it. I appreciate why they say it. I do agree that there has been structural underinvestment in things like oil and gas, et cetera, that would facilitate this transition. And it is entirely plausible that we experience a short-term cycle of scarcity. But the flip side of that is there are such incredible innovations that are right on the edge, right? Ranging from Gen 3 nuclear, Gen 4 nuclear, which most people understand, if we were to actually build the darn stuff, would dramatically lower our baseload energy costs. There's things like deep geothermal that is on the development block and coming very, very rapidly, that would allow us to replace the use of things like fossil fuels that are effectively an accumulated battery, from millions and millions of years of solar power, with the battery that sits at the center of the planet that continues to generate about half the energy content of the Earth, right? So we get half of it from the sun, we get half of it from the decay of radioactive particles and the pressure created in the center of the Earth. We haven't even begun to tap those energy sources. And so I just find it very disingenuous to spend all our time talking about energy as if fossil fuels are the only solution to it. I hate solar. I think it's a stupid idea. I hate wind. I think it's a stupid idea. But the baseload power choices that are beginning to emerge suggest that we're actually looking at an incredible surplus as compared to scarcity if we just have the courage to embrace it.
So interesting, and that's part of why in the solutions part of our special we are looking at energy and having those conversations. Adam asking a great question: do you have an opinion on risk to the system from direct lending, non-bank lending vehicles?
It's all the same thing, right? And so the real problem with that is we don't have a lot of transparency around it. We just don't have the information systems that we have for the publicly traded securities. The stuff that is privately held in many ways is lower quality, even riskier than what we have in the public markets. We're seeing that with the dynamics around the privately traded REITs, which have been gated in terms of their components. The frustrating part, and I use frustrating, is that what we've seen so far is an interest rate sensitivity, a duration sensitivity crisis that manifested itself in 2022 through a lot of dynamics like systematic portfolio rebalancing, right? So just pause yourself for a second. Imagine you run a 50-50 portfolio that systematically rebalances between equities and bonds. The Federal Reserve hikes interest rates, bonds fall in price, they become a smaller portion of your portfolio. How do you have to respond to that? You have to sell equities, buy bonds, right? You rinse and repeat that. That looks exactly like what happened in 2022. Now, the flip side of that is there a credit crisis that emerges on the other side of it as we raise interest rates and companies are forced to face this refinancing dynamic that we've hit? The quick answer is it seems obvious that there should be something, but we just haven't seen it yet, right? So to argue that we know exactly what's going to happen, very hard to know, right? But what seems very obvious, unfortunately, are things like the risks that exist within commercial real estate, where occupancy has absolutely collapsed. We're now seeing an economic cycle which typically results in less demand, even as tons of construction that was put in play during the period of low interest rates, et cetera, is expanding supply. So, and that's the primary asset that's held in many of these smaller regional banks. Nothing we've seen so far is beginning to address those dynamics.
Mike, what about the pension system? You know,
Well, the
we're
pension
seeing
system
this
has,
this major move in rates and this
yeah.
fallout from the level of rates. What should we be
Well,
thinking about in terms of pension? Because that was the source of concern for a lot of people when we were looking for what might break.
yeah. Well, so I'd suggest that there's a couple of things that are important about that, and unfortunately, I'm going to run out of time relatively quickly. Um, Pension systems on the private side were actually helped by the high interest rates, right? So if you think about the dynamics of what happens to a pension system, even as their assets fall, the discount rates that are available for the private pension systems rose enough that the future liabilities became worth less. On the private side, we've actually seen most pensions, the vast majority of pensions, move into overfunded status, which is creating its own somewhat unique risk in that suddenly corporations that have traditionally offered these types of strategies can defease or de-risk their exposure by moving into bonds, right? This is, in my opinion, one of the things that's created the demand for bonds in the past couple of months that we've seen flow through in a variety of ways, as these corporations say, like, why take the risk? Why do we care anymore, right? On the public side, you see a very different situation in which these entities are horribly funded. By and large, they've moved away from any form of actual funding to a pay-as-you-go type system, which is going to place burdens on the budgets of municipals, et cetera. And all of them are suffering, right? You've seen California move from a surplus to a deficit in, fantastically short order as it's forced to deal with this stuff. We're just a very long way away from resolving it. And then the last thing I would say on pensions is remember that the American pension system is largely a defined contribution system at this point as compared to a defined benefit system. Those assets that are in 401ks and IRAs, the combination of the two, I believe, is now somewhere around $23 trillion in total exposure. The vast majority of that is held by baby boomers who ultimately will need to be taking withdrawals from it. But again, the great irony is by raising interest rates as high as we have, we've actually created conditions under which they don't need to tap their principal. If they were to simply flip around and buy a 10-year, U.S. Treasury or a 30-year U.S. Treasury yielding 4%, the great irony is that you could simply withdraw the interest for very, very wealthy individuals, and meet their required minimum distributions and their income needs without selling the principal. The question is, can we transition? Can we actually see them sell equities and buy bonds without causing huge disruption, those flow characteristics? And then, of course, the last thing is sitting out there. We have the whole target date fund dynamic now around $3.5 trillion to $4 trillion worth of assets that are purely systematic in their construction and mechanically are beginning to de-risk by selling equities, right? That's a new innovation that we don't fully understand how that's going to impact things going forward, although modeling suggests that you'll end up seeing passive sales at some point in the future. We just haven't seen them yet.
Right, which is why you spend so much time focusing on this. And we will do that longer pension conversation at some point. I know we're almost out of time. You talked about when we did the podcast, feeling like there was something that was going to go and wanting to be ready for the opportunity. Oliver asking, how do you balance buy tech because the Fed's going to stop raising rates soon, the pivot with the recessions coming when it comes to managing your portfolio? How should people be thinking about things in this environment that we're facing with so much uncertainty out there, Mike?
Well, the way I've tried to construct my portfolio is to actually emphasize that outstanding credit risk. And so my core exposures within equities are basically saying, look, if that analysis is correct, you'll see an improvement in the less levered companies relative to the more levered companies, right? And by and large, that's how my portfolio is constructed. It's cautiously long underlying equity exposure in the form of the S&P 500. I'm doing that through in-the-money call options that allow me to have a relatively levered position to that while at the same time limiting my absolute exposure in terms of the size of my portfolio. And then I've got a fairly sizable number of credit bets that effectively say, the economy is slowing and we'll see that credit cycle kick in. Whether that's right or wrong, we'll only find out in the future.
That's right. Well, Mike, thank you so much for taking the time to be with us today, because I think that it's really important for everyone to try to focus on some of the underlying causes of this. because there are a lot of different narratives out there. And it sounds like that's something that's much bigger. It's going to take a lot longer to unfold. And we all have to be really on alert here, certainly through the coming months as we try to figure out what this is going to look like.
Well, that's the fun part, right? Being not alert is just boring. So yeah, I hope your audience enjoys themselves and that this was helpful and that they're all being thoughtful and prepared as they look forward.
Absolutely. Mike, thank you so much. Always a pleasure to be with you. And thanks to all of you. We will be back, of course, at 4 p.m. with the daily briefing. So be sure to join us then.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.